Hey, what's going on everyone? It's Griffin here and I hope you're all having a great day as always. Now, I'm sure a lot of you clicked onto this video as fast as you possibly could when you saw the thumbnail because a ton of you have been requesting that I make a Canadian real estate investment trust industry comparison update video. And yeah, it so happens that I haven't done one of these videos in several months. A lot has changed since Q3 2020 when I last did one of these regarding the actual companies themselves, but then also the actual market environment that these companies are now operating in. And this is especially true for retail focused REITs that have unfortunately been forced to open, close, snip, snap. And that's also had a toll on many of their retail tenants. Now we'll be speaking about all of this in much more detail throughout the course of the video, but all things considered, I'm actually quite surprised at how well most of these REITs have fared over the past year. And yes, of course, some of them still have share prices below their 2020 levels, and some have also slashed their dividends. But considering the fact that what we witnessed over the past year with this global pandemic is something that most of these real estate investment trusts could have never predicted and have never actually witnessed before, most of them have actually been doing all right and have rebounded quite nicely in regards to how they're handling the situation and looking to move forward. I definitely don't need to recap the entire last year and a half for you. Chances are, if you've been alive, you're well aware of how difficult it has been for retail, both the actual vendors and the landlords, especially up here in Canada. But we're now at a point where it's been over a year that we've been faced with the challenges of this pandemic. And let's say last March of 2020, it was a huge unknown for most of these real estate investment trusts. Now they've had quite a bit of time to absorb what is happening and try to rebound and reposition themselves for the coming years, essentially. So even though real estate is slow moving, this is quite a bit more time than only a couple of months. And we also have a better idea of how these companies are trending now regarding tenant issues, rent collection, etc. from an investment standpoint. With that said, even though it has been quite difficult regarding rent collection and tenant issues for some of these real estate investment trusts, one thing that did play in the favor of REITs over the course of this period of time was extremely low interest rates. And for anyone or any company looking to borrow funds in order to build property or any other construction project, when interest rates are significantly lower, it essentially makes it a lot more lucrative for these companies or individuals because the cost of borrowing goes significantly down. Real estate investment trusts are also well known for their higher than market average dividend yields, and without getting into full detail about why this is, real estate investment trusts are forced to redistribute a high portion of their net income back to shareholders in the form of distributions. So anyways, in today's video, we're going to be comparing head-to-head 8 of the top Canadian real estate investment trusts spanning a variety of different industries within real estate as a whole. And that includes, for example, office buildings, retail, residential, as well as industrial. And by the way, if you're newer to the channel and happen to have missed my past real estate investment trust industry comparison videos, essentially we're going to be diving into an Excel spreadsheet and comparing all the data in columns for each one of these 8 real estate investment trusts to see how they stack up and try to determine which ones are most promising from a financial standpoint. And with that in mind, since this is a financial comparison, I will try to add supporting qualitative information when necessary, but it's mostly going to be a financial comparison, just looking at these funds data as of right now. I just wanted to put that out there before we dig into the numbers. All right, so let's do it. We'll dig into the Excel spreadsheet. Honestly, this took me so much longer than I was anticipating. It took me like 4 hours to read through all of the financial earnings documents of each one of these REITs and compile the data in this one spreadsheet. So if you enjoy this video, I would just ask you that you give me an early thumbs up right now. And then also, if you're newer to investing, make sure to check out the links down below to resources like Wealthsimple Trade or Questrade to open up an account, and you'll get some free money when you open and fund your account. So with that said, let's get right into it. All right, so here we are in the Excel spreadsheet comparing these 8 Canadian real estate investment trusts. So just like in the last one, I've essentially put the data into a bunch of different little sections here. We'll go over them quickly, but first and foremost, the real estate investment trust we are going to be looking over are Allied Properties, which is an office building REIT, Dream Industrial, and Granite REIT, which are industrial real estate investment trusts, followed with the only residential one, featured in today's video, being CAP REIT. Then we have Brookfield, which is the largest REIT by far in this list, and they have a variety of different types of real estate ranging from retail, office, commercial, etc., and spread pretty much around the globe. Next up we have REI-UN, which everyone is most likely familiar with. They are one of the largest retail trusts in Canada. We also have Smart Centers, which is also a retail REIT, and then the last one being H&R REIT. They also have a mix of office, retail, and residential. Now, one thing that I want to mention straight off the bat before we dive into the numbers is the fact that up here I've written that it is all in millions as of March 30th, 2021, except on a per unit basis. And that also includes in terms of a per share basis, essentially. So for example, February 2020 peak, obviously this is just $60. It's not $60 million. However, revenues Q1 2021 at 140.84. This is $140.84 million. And with that said, let's just quickly go through the sections of data. So up here we have a section of data relating to the current price as well as what the price movements have been over the past year, as well as the yield. From there, we have information relating to revenues, variance in revenue since Q4 2020, revenue growth quarter over quarter, as well as net income and net operating income. The next block of data has to do with the percentage of rents being collected, increases in rents, property acquisitions, essentially information relating to how the company is operating in terms of their leased areas, their leases, etc. The next three blocks of data right here, they relate to balance sheet figures. So assets, cash equivalents, total ratio, etc. And we'll jump into that later on. And then finally, the last block of data is the funds from operations, which I'll be giving you an explanation once again, just to refresh your memory on what that is, as well as distributions paid and the distributions to funds from operations. So we have lots to dig into. Let's start with the top section, starting with Allied Properties. Okay, so that top row here, I put the February 2020 peak, and this is in relation to the share price that it reached before the crash in 2020. I'm not hiding anything from anyone here that the 2020 crash was extremely detrimental for real estate investment trust in particular because of the type of business that they operate. And so this was seen as a ripple effect throughout the entire industry. Most of these have actually recovered quite a bit from their huge drop in March 2020, but we're still seeing some of them in the negative quite a bit. For example, Allied Properties, which is an office building REIT, it is still down roughly 28% since the February 2020 peak. The real estate investment trusts that have done the best without any surprise really are the industrial REITs, being Dream and Granite. These have actually appreciated back above the 2020 levels. So even if you had not sold off any shares and you purchased at the peak in 2020, you would now be in the black, and that doesn't take into account any of the dividends that you would have incurred along the way. And then somewhat unsurprisingly, the other ones, CAP REIT, Brookfield, REI-UN, Smart Centers, and then H&R are still below their 2020 levels. The worst ones being REI-UN and H&R REIT, and we'll try to discover why that is with the data later on in the video. In terms of their dividend yields, most of them are still quite a bit higher than industry average, even though some of them did cut their dividends, being REI-UN and H&R REIT. They did cut their dividends in 2020. The highest yield remains Brookfield at 7.58%, even though we're going to see they did have quite a hard time over the past year. And then the lowest is CAP REIT at 2.39. Everything else is actually quite average and relatively good for any dividend portfolio. Anything above 3 is a pretty good dividend yield. All right, so moving on into the next block of data, which has to do with their financials. Let's start off with the first row being their revenues. So I've inputted the revenues on the top row here for each one of these REITs. And then for comparative basis, we have Q4 2020. Now, the reason why I didn't put Q1 2020, instead I put Q4 2020, is because the figures that we saw in Q4 2020 were right before the huge huge drop in overall revenues that these REITs saw in Q2, Q3, and some of them even Q4. So I didn't necessarily think that it was all that relevant as a comparative basis, because these REITs have adapted quite a bit since then, and well, they've had to adapt to the market environment. So Q4 is the quarter prior to Q1 2020, and this is after about 3/4 of these REITs trying to adapt further. So I thought this was a better comparison. So the revenue growth quarter over quarter, in green we have trusts that have managed to increase their revenues over Q4 2020, and then in red obviously ones that have gone down in revenues. The worst one being Brookfield at negative 11.72% since Q4 2020. They have quite a few hotels in other countries. For example, the Grand Bahamas, that is owned by Brookfield. And from reading through their earnings statement, they have had quite a hard time with the rental collection for quite a few of these hotels. And then once again, unsurprisingly, the industrial REITs have had no issues whatsoever with both rental collection, but then also actually increasing their revenues over time and their rents. For example, if we look at this row down here regarding the percent of rent collected in Q1 2020, the industrial ones, 99% for Dream Industrial, and then I couldn't find it for Granite REIT, but considering their increases in revenues and their stability in income, I'm assuming this is around 99% also. Now, the only REITs that did have significant issues with rent collection over the course of the past year were really right here, being Brookfield, RioCan, Smart REIT, and H&R REIT, really just because they have a larger portion of their portfolio being in retail. However, I will say this, okay, so RioCan 93.9% collected in Q1 2020. That's actually quite high considering what it was in Q2 and Q3 of 2020, where, for example, I know Smart REIT, it reached about 77% rent collected in Q3 2020, and now they've managed to increase that back up to 94%. That is actually quite impressive and very good for the future of this REIT. All right, now quickly here, I just realized that we skipped over the total net income. Now, net income for an REIT isn't all that relevant, and here's the reason why. So with an REIT, they are going to take into account the rental income, but then also take into account the gains on sales of property, and then also the gains or losses on fair market value of their portfolio of assets. And that is going to be seen on the bottom line, being the net income. So it's not all that relevant. And the reason why right here I put these in yellow is because the net income, let's look at Granite, for example, right? They made 95 million in revenues in Q1, but their net income is 230 million. Obviously, that is not derived from their actual rental income. This is because in Q1 2020, we've seen a massive increase in the fair market value for this REIT, for their portfolio, essentially. Over the course of 2020, there were massive net losses on the income statements of most of these REITs. If you look back in Q2, Q3, Q4 even, you're seeing massive net losses. However, these were pretty much just paper losses as a result of severe swings and fluctuations in the fair market value for their portfolios. Okay, so moving on through the rows of data, let's jump to the interest coverage ratio. Now, quickly, if you're not aware of this, let's just jump over to Investopedia and see what this is. So the interest coverage ratio is a debt and profitability ratio used to determine how easily a company can pay interest on its outstanding debt. And the interest coverage ratio may be calculated by dividing a company's earnings before interest and taxes, being the EBIT, by its interest expenses during a given period. Without going into too much detail about this, essentially the higher the interest coverage ratio, the better. And as a baseline for an REIT, an interest coverage ratio of about 3 would be around the bottom line. So most of these do have an interest coverage ratio above 3, except RioCan here at 2.99, the best one being Granite REIT at 6.5, and Dream Industrial at 4.8. We're seeing a pattern here that industrial industrial is definitely the way to go in terms of investment right now for their overall portfolio and tenant strength moving forward. The next row has to do with the leased area, and what I mean by this is of the entire amount of square footage that these portfolios, that these REITs have in their portfolios, what is the current amount of it that is leased out? Once again, Dream Industrial 97 and Granite REIT 99. So pretty much the entirety of their portfolio is rented out right now. Brookfield does have a lower amount for their office at 89% and 92% in their retail portfolio. Quite surprisingly, you know, our REIT-UN and Smart Centers do have pretty high overall leased areas at 95 and 97%. Now, some of these tenants haven't potentially been paying. However, we have seen that they've managed to increase their percentage of rent collected. So they're definitely moving in the right direction here and trying to recover as well as possible from the quarters last year. Okay, moving through the data here, I know there's a lot to take in, but let's jump to the weighted average remaining lease term in years. So most of these real estate investment trusts are going to sign multi-year leases with their tenants. It's not necessarily like a residential lease for your apartment where it's typically going to be 1 year. Most of these REITs will sign, 5, 10, even up to 15-year leases. For example, I know Granite REIT, they have Amazon as a client, and some of their leases with this company are up to 18 years, which is pretty staggering. Now, honestly, I just put this because I found it interesting and somewhat relevant to include. However, anything above a couple of years is just going to increase the overall rent income stability for these REITs. And with averages pretty much above 4 for all of them, there isn't necessarily anything to highlight. And even still, just because the REIT has a lease with a tenant doesn't necessarily mean they're going to be paying as we saw last year in 2020. All right, now jumping to the next 3 blocks of data right here. To be honest, I'm not really going to spend all that much time here. These are the balance sheet figures. So we're talking about cash and cash equivalents, the current ratio, and total ratio as of Q1 2021. One thing I will speak about though is the dividend, whether or not the REIT cut the dividend over the course of 2020. They pretty much all didn't except REIT-UN as well as H&R REIT. REIT-UN, I'm pretty sure, cut it by 30% if I remember correctly, and H&R REIT cut it by 50%. Smart REIT, they only suspended their dividend reinvestment plan and they didn't end up increasing the dividend over the course of last year. Okay, and then finally, the last block of data here, we have the funds from operations, acronym FFO, as well as the FFO per share, the distributions paid throughout the course of 2021's first quarter, and then finally the distribution to FFO, which is essentially the same sort of thing as a dividend payout ratio for a typical dividend stock that is not a real estate investment trust. Now, the funds from operations, you may be familiar with this term if you've watched any of my previous REIT content, but just in a nutshell, this is essentially the income that a REIT is left with from their rental income after taking into account everything that has to do with operating the properties as well as the expenses. It will not take into account, however, any gains on sale of security, because that would be a one-time gain for the company in question and is not recurring by any means. So in terms of the overall growth in revenues and the stability of their income moving forward, it's much more relevant to look at the funds from operation as an indicator of the financial health and direction of a real estate investment trust over, say, the net income. Now, I color coded them in either green or in red, depending on if the funds from operation increased in Q1 2021 over Q4 2020. However, for the most part, even if they did decrease slightly from quarter over quarter from Q4, pretty much all of them across the board have managed to significantly increase their FFO since, say, Q1 2020 or even Q2 2020. Now from there though, the distributions to FFO, in relation to what I just said, being that the funds from operation is more relevant to look at for a real estate investment trust, well, instead of looking at the dividend payout ratio, which takes into account the net income, we're going to be looking at distributions in relation to the FFO generated. So typically a real estate investment trust is going to want to have an FFO that is below, or a distribution to FFO that is, that it would be below around 70%. 8%. Most of them have a pretty high dividend to FFO right now, the worst ones being the retail REITs at 92 and 95%. Now RioCan at 92%, let's also consider that that's after a current dividend being cut as of last year at around 30%. So they still have a pretty high dividend to FFO. And then again, these three right here, nothing really to worry about, and I don't think we'll be seeing any dividend cuts at all. And then Brookfield kind of stands out at 371%. Here's the thing about Brookfield though, I've looked at their historic dividends to FFO over the past 10 years. They have always maintained a distribution that is extremely high related to their FFO and even their net income because they do have higher cash flows. So they did not end up actually cutting their distributions in 2020, and they've been maintaining their distributions for several years now, increasing them steadily. So it's sort of like an anomaly here where they have a really high distributions to FFO, but I doubt they're going to be cutting them moving forward. All right, so I really hope that this Excel spreadsheet gave you some further insight into what really you should be looking for from a financial standpoint for real estate investment trust, and then also which ones I believe would be better selections as of right now for prosperity in the future. Obviously, we can't treat all of these real estate investment trusts the same because, well, they're not, and then also they hold different forms of real estate in their portfolios. Over the past year, one of the main investor fears was really severe tenant rent defaulting, and this did definitely happen for some of these retail-focused REITs more in the second half of 2020, but now as we are seeing a lot more of these businesses opening back up, hopefully permanently, especially with the rolling out of the first and second doses of the vaccine, this is going to help retail stay open for good and will help stabilize the overall rent collection of these real estate investment trusts. So I really hope you enjoyed the video. This was definitely a different style of video than what I've been doing more recently on the channel. Let me know down in the comments if you did enjoy it though, and if it did provide you value. If it did give you value, make sure to smash the like button. That's really all I ask in return. And if you want to learn more about a real estate investment trust and investing in the stock market in general, I would highly recommend that you check out the link down below to my full 60 video lecture stock market investing course, where you'll learn everything that you need from starting from scratch in the stock market all the way up to knowing how to navigate the market properly and have your own portfolio crafted for your needs as an investor. So with that said, thanks a lot for watching today's comparison video, and I will see you in the next one.